I'm trying to give you a good model. So if you walk into a job, I remember when I was a security analyst, the 12 seconds they gave me of training wasn't all that helpful. They don't tell you much in finance. They just assume there are some firms that have more training, but mine was. I remember they told the portfolio managers to train me on their industry. So the utility guy walked over with two books and handed them to me and went back to his desk. Said, "Here, read these." The computer guy said, I give you one lunch. You can take notes." And I mean, literally, he told me, "I never want you to speak to me again." So that's how arrogant some of these portfolio managers were. So I'm trying to give you, you walk into a job. Yeah, is this the best way to do it? Probably not. Will it work in a new job? Absolutely. They won't look at you funny. So it's not a bad approach. It's a little redundant because she kept saying she's using the implied approach. But the implied approach for KEs, so we need a risk-free rate plus beta times the market risk premium. Are your other classes the required return on stocks minus the risk-free rate? So I mean, either is fine. I will tell you in real life, every academic does it like this. No one in practice does it like that. Everybody does it like this. So that's the way I think. I just thought the market, another rock market risk premium is a required return on stocks minus a risk-free rate. You do that in interview, they'll look at you funny because no one thinks like that in finance. But your academic classes all do that. So if you take the fact exam, you have to make sure you know this one, right? Because they'll probably give you this number and you got to plug in the other. So be aware. It's not, this is just the definition of market risk premium. All right. So what is your risk-free rate? 425, pretty straightforward. So what is our required return on stocks? We assume it equals the expected return on stocks. How do we know that? That's the definition of the implied approach. So the implied approach says, hey, I don't know what required return on stocks is, but I can guess what the expected return is. We'll assume markets are efficient and those equal each other. What's that going to equal? A dividend yield plus expected earnings growth. And this is such the dominant approach that I would absolutely use this approach in your first job. It is so dominant now. It wasn't when I started. The historical approach was what we used when I started, but this is just so dominant. You're safer doing this. What might else we add in here? We might add back a buyback yield. We'll see what the boss says. I don't know what y'all are going to do on your paper. Um, if you're having trouble with massively high valuations in paper 4, you might add in the buyback yield to paper 3 to get you a little bit higher discount rate so you don't have such massive valuations. All right, so what is the dividend yield? She gave you two numbers, 1.6% and 2.5%. What do we use here? Say it again. 0.016. All right. And my expected return on stocks is what? She just gives it to you, right? Did you need all of this stuff? You don't need any of that stuff. It's nice that they're the same number, but I mean, she gave you all this number and you're like, why are you telling me all of that? But she gives you the number right here. And then she also gave you a buyback yield. So we're going to put that in there. All right. So dividend yield 1.6, buyback yield 1.5. So there's 3.1. So that should get you 9.1%. What if you get 13.7? You probably did something wrong. That's way too high. What if you get 2.3? That's way too low. You know it's going to be higher than your risk-free rate. But what's the typical um, market risk premium? It's probably going to be in that 4 to 7%, maybe 3 to 7% range. It's not going to be 1%. It's not going to be 15%. So if that's the required return on stocks, what I just hit. I can't tell. All right, I can't tell if the num lock is on or not. There's no light. My risk-free is 425. Then my market risk premium, 0.0515. That seems reasonable. Nine, it's going to be in that 4 to 7 range. Maybe 3 if you're really in the low end. I mean, if we left out this 1.5, you're talking what, 3.7 something. So you could get, if you leave out the buyback yield because dividend yields are so low today, you could get something below 4, but not below 3. That would be wild. All right, 425. Everybody agree with the 515? Did I do the math right? 910 minus 425. Oh, no, I didn't do it right. It's 485. All right, so I can't do basic math. All right, and then beta, we have to say the type of company, what we just say there? Definitely what? Defensive. Yeah, this one's pretty straightforward. Definitely a defensive company. There's some that are questionable, and I'll try not to give you one of those, but yeah, Procter and Gamble, they're selling toothpaste. When's the last time you heard someone say, you know what, I'm worried about my job here. I'm probably going to cut back on toothpaste the next few months. You're probably not going to hear that. They may cut back on restaurants or vacations, but hopefully they'll keep buying toothpaste and diapers too, especially. All right, what about the operating leverage? How volatile were their earnings? Pretty stable. No standard deviation of margins. It's just low operating leverage. So here we got beta, well, low one, low one, and financial leverage. Yeah, kind of in line. 76 versus 57, slightly above the market, but line, no impact. And then what did history suggest? Now, if you look at history after all of that and they're above 1.5 all the time, then maybe you got to rethink it. But what is their numbers here? The median's around 50.
Yeah.
They've been above 1, but that was a long time ago. Yeah, they've been negative.
Recently, the lag is kind of stuck in the same place.
Yeah. So, this, it's not a grocery store, but it's selling pretty basic products. It's almost somewhat of a monopoly, right? If you think about it, you got Procter and Gamble and you got the firm Unilever. It's a pretty concentrated industry, especially in certain products. Although I don't know if you ever read the story about Clorox bleach. There are some true monopolies out there. Why doesn't Procter and Gamble do bleach? And it's a wild story to find why does one company dominate a market like that. So my number, I don't know what you might use, but 0.5, what did y'all use in yours? 0.5, 0.5 seems reasonable. Definitely not 1. So 0.5. And so here again, you're going to get a number, maybe 5%, but that'd be pretty wildly low, huh?
For beta, like in the example, if you want to use like 0.5, 1.0, and 1.5, like one stage of those 3 numbers, you can also different, maybe see like 0.6.
Well, I mean, as long as I mean, like after all we did that, we come back with 1.5, it'd be bizarre. All right.
But like, you want us to stay there or like For example, like I thought the Parker Gamble was maybe not as defensive as like let's say a Walmart or an HEB.
Well, if you want to justify it, I mean, once you do all of that, say, okay, I think it's well below 1.
Yeah.
Its history suggests this, but my number is 0.7, as I think as long as your rationale is there, it's your number, right? So you're deciding how risky this stock is. And if you're going to say, 1.7, it'd be really bizarre. You'd have to write a few more paragraphs to make that. Procter & Gamble's coming out with a new EV or something, that would be pretty wild. But yeah, there's no right answer, but there are a lot of wrong answers. So yeah, you get to pick what makes most sense to you.
Their debt affects their data.
Yeah, but their debt's pretty much in line. It's not radically off. This is a fairly stable firm. Fairly stable firms can borrow more money, so that kind of makes sense. Whereas tech companies tend to avoid it. But you probably want to look at Unilever as well and see if they're in line with their competitor. This is kind of a one competitor firm, so it's a little rough. All right, so that's all you're after. Give me a number. 666675. Yeah, so it's rare you're going to see a KE below 5. You can see them above 10, but it's rare above 12 or 13. Although it's getting a little more common just because the risk-free rate's getting so high. But it's unusual. You're not going to see 20% KEs. You're not going to see 2% KEs. I'm not going to give you a negative beta firm either. All right, any questions on this? So it's not necessarily an essay question, but you do need to have those 4 steps in there and justify your number. But it's so similar to doing on paper 3, you probably already know it without having to look it up. All right. Let's finish up options a day. So last week we were talking about Texas videos. So if you look at this, T is for time, X is for the strike price. You can do TKS if you want to do K. S is for the stock price. V is for volatility, probably the most important thing. I is interest rates, which is more important today than it has been with rates higher, but it's still not massive. And then dividends can be important. And if you look at the most famous option pricing model out there, Black-Scholes, I'm going to do Wikipedia. It's a little easier. Y'all heard of Black-Scholes model? It is not a difficult formula. You can easily, I've plugged it into Excel. You can easily handle it. So trying to find the normal way it's written because that's not the normal. All right, so maybe I don't want Wikipedia. That's not the normal. I can't spell Investopedia. I just want to see the formula here. Right? All right, here we go. All right. I don't know why Wikipedia has switched it. You never know with Wikipedia what's going to go up. All right, so do you see T from Texas Video in here? There it is right there. There it is right there. All right, so for a call, you have all of these pieces. There's interest rates, right? Minus R to the T. K, what is K? Sure. Strike price. They use K, not X. What's the N? I mean, it's amazing. It's this simple, but it really is simple. The N is nothing more than getting the number off the normal table. And y'all believe it's that simple. That's all they're doing. Assuming a normal distribution and just pulling a number. What are they saying with this N? I mean, it's pretty crazy. They're just asking, given the volatility of the stock and given a normal distribution, what's the probability this option will go into the money? It really, I mean, isn't it amazing how simple this formula is? You see the S in there, the stock price, interest rates, all of those pieces. What's the one thing missing in here? So that's what we're trying to solve for. The S is the stock price, K is the strike price, interest rates, time. Where's volatility? There it is right there, right? There's volatility, the standard deviation of the stock. What else is missing? So T, X, S, V, I, what's the one missing? Dividends. There's no dividends in Black-Scholes. They had to fix that later, so they didn't adjust that. But it's all in there. It is not a difficult formula. I don't have the formula memorized anymore. I memorized it for the CFA exam. It really helped me on a Ginny Mae question. It's not a formula most people have memorized. Now, if you take an option class, they'll teach you two models. They'll teach you Black-Scholes and they'll teach you the binomial. Which do you need to know? And the answer is neither. You don't need to memorize either of those. If you're buying options, you're not trying to figure out the options mispriced. So what are these two models, binomial and Black-Scholes, trying to do? Are they trying to give you away the value options? No, what they're trying to do is back into how options were already being valued. I mean, it's kind of crazy, right? It's not like Black-Scholes showed up and like, well, we don't know what options are worth. And they showed up, gave a formula. It's like, no, we already knew what options were worth. You already had the prices. He was trying to back in. I mean, it's pretty crazy. He was trying to back into what the options people already knew, but it put it into a formula. Right. So he's trying to find a formula that says, hey, what is the price of this option? Right. So he's assuming the market's right and they're trying to back into it. So the market already kind of, I guess, intuitively already knew what an option was worth. Somehow they were doing it and they had to come up with these models to do it. Why do options classes spend so much time on those models? I guess you need to know it. You'll probably forget it right after the class, although it is good to know it for the CFA exam, especially part 2. But you know, I trained a bunch of options. I didn't use option models unless I needed there was some kind of like people who had options in a firm and I was trying to figure out the value for them for compensation at USA or some off the charts. I once had to do a problem, which was bizarre. USA had an option on the Spurs. I can tell you this now. I couldn't tell you when I was there. So obviously I've heard of the Spurs. So we had an option on the Spurs, and they asked me, what is that option worth? We just got Tim Duncan. So what happens if Tim Duncan breaks his leg next week? That could have an impact in the option. So I called Dr. Miser here at UTSA, and we walked through it, and he gave me a good way of thinking about it. A little bit more difficult, right? What's the standard deviation of the Spurs? It's not a publicly traded company. What's the strike price? I had to try to manufacture the inputs into this model. So I have used it for some strange cases, but most people who trade options, what valuation are they questioning? Not the value of the option. What are they asking? The value of the underlying. Do you think Apple's overpriced or an NVIDIA? And then you're going to buy the option. Now, it is true the option has one really, really important input called volatility that you could strongly disagree with that volatility number. And if that's the case, then yeah, that's why I buy a lot of options when the VIX is really low, because that means they're incredibly cheap. So I kind of implicitly think, well, options are mispriced. But generally, we're not trying to figure out the value of the option. This formula is really just telling us how the market does. So the key here is how these impact things. So the strike price, the higher the strike price, the less valuable a call option is. The higher the strike price, the more valuable a put option is. Right? Why? Because you have a higher strike price, that's what you have to buy the stock at. The higher that is, the less valuable that is. The put option is what you get to sell it. The higher the strike, the more valuable that is. The current price is the exact opposite. The higher the current price, the better the call option is. Because if you get to buy it at 100 and it's trading for 150, that's more valuable. The exact opposite on the put. The higher the put option, the less valuable the put. Everything else kind of, well, the other two important ones go in the same direction. So for strike and stock price, calls and puts are opposites. For time and volatility, more time, more volatility, the more valuable the option. Doesn't matter if it's a call or a put, right? We know the strike price when we buy the option. We know the time when we buy the option. We know what the stock price is when we buy the option. We know what interest rate are when we buy the option. The only thing we really don't know is volatility. So there's something called implied volatility. It's not the historical volatility, it's the volatility implied over the time of the option. And you can pull that out. The CBOE, their calculator, will actually, if you put all the inputs, it will tell you what implied volatility is. Implied vol is really easy to get out of Bloomberg. It's the one unknown when we start, so it is one area you could disagree with the option pricing. It gets quite complex, but you could disagree with it. So options like volatility because it's, remember again, that N is the normal distribution. The more volatile you are, they're trying to ask, what's the chance you go to this part of the tail? And the more volatile you are, the flatter the tail, the flatter the distribution. So you're more likely to be in that tail. So it increases the value of the option. Interest rates, higher interest rate make calls more valuable. Why? Well, because if rates are high, you're not having to buy the stock today, you're using the option to delay that. So that's a value to you, and it decreases the value of the put because you could sell it today, but with the put, you're somewhat delaying that. But I wouldn't worry too much about on interest rates. Most people have to look that up. And then dividends, if you take an option pricing class, Brian teaches the speculative markets class. So you could take that. They would cover options and futures in that class, but they will spend a lot of time on option pricing models. You probably should see them once in your career, but not radically important that you remember it. And then there's the Greeks. Y'all probably have heard of the Greeks. There's kind of a tie to the Greeks in Texas video, not exactly the same. But delta tells you how will the option change given a percentage change in the underlying. So how much will an option on Apple change if Apple falls 10%? That's your delta, all right? It's how much kind of exposure you have. If you go on to Bloomberg and do their option kind of function, they'll give you the delta and the gamma and the theta and all those kind of things. The gamma is the second level. It's kind of like, you remember duration and convexity, first order, second order. Delta and gamma are just like that. Delta is the first order. Gamma is how does delta change given the change? Gamma is extremely important when we're talking about collars. Remember on collars, your delta may be okay, but boy, you start approaching that collar, your delta is going to nosedive. So you remember on the collar, let's show the collar. Oh, we haven't done a collar yet. We'll have to do a collar. But on a covered call, your delta might be one to one, right? And here, our percentage-wise might be more. But what's your delta up here? How much is the option changing given the change in stock price? Zero. Yeah. So your gamma is going to tell you, hey, your delta is going to nosedive once you hit this level. So gamma can be extremely, extremely important. There are certain option strategies that have good looking deltas but horrible gammas because you're going to hit you can have a level. Theta is how much does the option price change given that you move one more day in the time. And remember, theta is going to decline. It's going to be much bigger as you get closer to expiration. So when you're 2 months away, it's a pretty small number. Once you're about a month away, it starts going really fast. And then vega is how much does the option price change given a change in your volatility assumption. And then rho is interest rates, which don't change as much as the other things. So So how much the option price change given a change in interest rates? It really could have been interesting these last few years with interest rates shooting up so much. We're talking 3 months, right? So this a discount rate of 0.5% versus 4% over 3 months. It's material, but not nearly as material as the other things. So Bloomberg, if you put an option in Bloomberg, will give you all these statistics. You could test it and see what they do. You could look at a covered call or a caller and look at the gamma and the delta and get some sense of what's going on.
So for Vega, it would be kind of like what you were saying, where Tim Duncan, he got injured. So that Vega would be pretty high then for like this.
Well, I'm not sure of the impact in Vega. Tim Duncan was more the S, the value of the Spurs. And we had an option. So what would happen to the value of the Spurs franchise if he got injured right after we got him? Probably would have dropped pretty dramatically. And so our option would have come down just because the S fell so much. It's true, Vega could have fallen as well. What's the new player in the Spurs? I don't even watch him anymore. What, 7'10" guy? What is this? Yeah. I mean, he hasn't had quite the impact that Duncan has. I haven't been watching at all just because, I'm a fair weather fan because don't have time. He was coming in pretty hopefully could have taken how long it take for Duncan. I mean, it kind of helps when he shows up and Robinson's still there. That kind of helps a little bit, right? So I'm trying to take all these in. How much would someone value the Spurs? So just because Tim Duncan comes in doesn't mean he's going to change the franchise. So it was really in a pretty uncertain time. So I think the volatility was already pretty high because we really didn't know how he's going to work out. We knew he's going to be a great player, but how good. So I had to bring all that in consideration. But yeah, if you got injured, I think the S would have fallen. I'm not sure the Vega because you would have said, man, this team's probably not going to do anything, right? It could have fallen, right? Less uncertainty because, man, if he's out, what hope do we have? So it depends. It's not as that you see it was a pretty tough question, right? I came up with a model. It was a really simple model. I mean, it took me like 3 seconds to run it. The lawyer would call me like weekly. And back then I was kind of mean. I would say, let me run it through a model and get back to you. I could have told him right there, but it was like, I wanted him to think it was a lot of work, but yeah, I don't know why I did that. Really good, nice lawyer, really great guy. All right. So we've done long calls, max of S minus X. We've done long puts, max of X minus S. We've done a protected put. You do the put and you have the underlying stock. We've done covered calls. You own the stock and you sell the call. So the only two things we have left are collars and straddles. So collars are pretty simple. It's the protected put and the covered call together. You own the stock, you buy the put, you sell the call. All right. We did a lot of collars at USA. That was kind of our strategy. So let's do Tesla. I don't know if that's what have we been doing Tesla? Yeah, let's keep doing Tesla. Stock price might be a little bit higher today, 162. $194. Did y'all own Tesla last Thursday? It's a pretty good rise, isn't it? 194 versus 162. Why didn't you put your entire net worth into it? All right, so we need a call option. We need a put option. Now on time, what we did at USA, since we're selling the call and buying the put, we would do the call 1 month out and the put 2 months out. I'm not going to do that here, but we did that. Why? Because if you're selling an option, time decay is your friend. Because that thing, you're selling something that's the decline. So, and options decline fast that last month. If you're buying an option, time decay kills you. And since time decay is that last month, if you give yourself an extra month, you can then sell the put option with still a month left and maybe get some value back from that. But we're going to use the same time on here. So let's go to their options. Let's go out. Let's try October. That's too long. Yeah, you wouldn't do a collar out that long. You really wouldn't. Let's go out to August.
What's the time frame for,
Well, generally anytime you're selling an option, you really don't want to go out 5, 6 months. I mean, that's just you're stressed out for 1 month anyway. To be stressed out for 6 months, it's just we did these things. Oh, I just too stressful. And I don't like being stressed out because something's going up in price. It just seems strange to me. It's like, oh no, the price is up. All right, so let's try. We're gonna do it out of the money. Let's try. I don't know. Let's try 220. So we're doing 8/20/24, 220, and the price. So this is important because we're selling the option. So what are you gonna receive? 1485. You get the bid because you're selling the option. All right, and then the put option. So the strike here is going to be out of the money. Let's go down. We'll see how far down we can go here. They were just at 160, so let's do that here. 750 versus 775. We're buying the option, so you're going to use 775. So at expiration, I'll have to change this, definitely. Yeah, that'll work. All right, so here we need the stock gain, so it's worth 120. We bought it at 194. You lose 74 bucks. The put gain. Yeah, remember the formula? Equal max. So put, start with the strike minus the stock. So there we made 40 bucks. And then the last part, minus the premiums. So we're gonna make what, 32.75 or something? 32.25. I can't, man, my math's not too good today. What's the most we can lose? 775. Once we hit our strike, we're just gonna pay the premium. All right. Now this is really important. We're a short call just like we did before. So what I recommend is put the formula down, max of the stock price minus the strike. Just do the entire formula, comma 0, minus the premium. Do that, and then what do? So just do the normal formula, and then what? You're selling the call. Just take a negative and take that entire equation and go positive. So if the stock price falls, what happens to that $14.85? It's all yours, right? You get to keep it. So you kind of like that, right? And so here's the collar. You just add that together. So if the market falls, you only lose 26.90. That's the most you can lose. If it falls to 20 cents, guess what you're gonna do? You make 26, you lose 26.90. All right, that sounds pretty cool. But what do you notice on the upside? And where's that coming from? It's that call, right? Your call is losing, being offset here. The most you can make is 33.10. Let's see if I can move this over and bring the stock price over. So I don't know what that looks like, but the upside looks a lot like the covered call, doesn't it? You go up. So you see it's very much like the protected put. where you have that protection on the downside. Looks like the covered call. We're losing the upside. So it's a strange. So how do you do this? So at USA, our goal was the majority of the time, we want to be in this range. Because if you think about it, it's actually pretty cool. We're receiving 1485 and we're spending 775. So if the stock stays in that range, we make an extra $7.10, that's pretty cool. Now,
That's your, I still get confused on the blue and orange line. I don't know which is which.
so the blue's the stock. It's just a straight line, right? If Tesla stock price goes up, you make that much money. If it goes down, you lose that much money. We bought it at 190, so 190 is our zero line. As it goes up, that's how much we make. As it goes down, that's what you lose. All right. The orange is the color. All right. There's something called a zero cost collar. Any guesses on what that means? Zero cost collar. What would be our goal there? Yeah, so you want to make the call premium and the put premium exactly the same. So what could we do here? Well, here, what we could do is we could actually go further down. I mean, go further up on the strike, the 220. We could take it, well, I don't know. We want 775, right? $775, we're selling. So 255. And what's the cost of this one? You bring in 760, you spend 775, it costs you almost nothing. You notice what happens to the line? When it stays in that range, you do exactly the same as if you bought the stock. And outside of the range, you give up the upside and you cover the downside. All right. But most of the time you're trying to stay in this range. So this range, since we're only, normally going out 1 or 2 months, if the range is 10, 15%, stocks don't usually move 10 or 15% in a couple of months. So most of the time you're going to be in that range and you're just covering yourself on the downside by giving up some of that upside. Right. So it's not a horrible strategy. It does work. All right, that's a collar. And then our last one is a strangle. Strangles are really popular. So this book right here is all about straddles and strangles trading on corporate earnings news. He likes to do strangles and straddles right around the firms are announcing earnings, because that's when you're going to hit the biggest swings, and that's what you're after. Strangles and straddles, volatility is your friend. You want volatility. Unless you're selling. If you're buying, you want volatility. So this is a long strike strangle. So what are you going to do here? We're going to buy a call option and we're going to buy a put option. And I'll stay with what we did before. I have to change one thing, but we'll stick with the put option. So I got to change this because we're buying them. So I can't use the bid. I have to use the ask. And so if I look at that, I got to use, wow, that's pretty cool, right? 775, but it doesn't really impact us here because we're buying both of them. But just coincidentally, they came out exactly the same. So we're buying that. So we're out $15.50 to start with. That's pretty expensive. But we're long on both of these. So the stock gain is just, hey, 120 bucks. We bought it for 190. So the same thing we had before. The call gain, exact same thing, equal max. Stock minus the strike. comma 0. And here we're long on it, so we don't make any adjustment. That is our loss. That looks pretty bad, right? But how does it work on the upside? Pretty good. All right, then we do the put. Here, equal max, the strike minus the stock, comma 0 minus the 775. Wow, that's pretty good, right? That helped us. This is a very unusual one. So the strangle, I shouldn't have done it like this, but here you got the call, you got the put. You don't have the stock. So this one doesn't look too exciting, but that's what a strangle is going to look like. Normally we're not this far off. So let me do one that's a little bit closer. So here, what you'd really want to do with a strangle or a straddle is you'd be pretty close to the current price. So if you use 190, it's 26.70. We're not going to like that. It's going to be really expensive. So 190, 26.70. And then on the put, the same thing, 190 and 1930. So that's costing us a lot, right? I mean, right there, we got 46 bucks. The stock's gonna have to move 46 bucks just to get our premium back. What letter of the alphabet might this look like? A V, right? Or a check mark, I guess. So you see what I mean? That you love volatility here. You want this stock to move forward. And that's the reason you do this around earnings announcement time, because you want the stock to move incredibly. Because if it doesn't, you're out of a lot of money. Uh-huh.
When you were trading options for UTSA, what was your favorite strategy?
Well, I like collars, but we couldn't do some strategies like this because our policy was written such that all of our strategies had to be risk reducing. We couldn't be speculative, so I couldn't do those others. One thing I will say on anytime you're selling a call, this is my rule at USAA. So if I sell a call option and the stock drops, so I had some call options, I might have sold them for 10 bucks, and the stock really drops, so that call option's falling. If I can buy that call option back at a 95% discount from what I bought it, I'll do it. If I can close out that call. So I did that in, I remember my best trade was right after the financial crisis in 2009. We sold a call option, the stock market crashed. We bought this call option back and the market rallied. And we were so happy. Credit Suisse was like, we're going to do everything Ron says. You know, it's like, no, that was pure luck, but it was really nice. You know, the market falls, you know, you sold something for 10 bucks, you can buy it back for 23 cents. Why not? Why not shut that down so you don't have to worry about it, especially as volatile as markets were. So I don't like short options, especially calls. So if, you know, I'm not going to be greedy. I don't need to go from 10 bucks all the way down to 0. Just, you know, I'll buy back at 23 cents and shut it down. That's my negative on that strategy. I can show you how it worked. I'll show my risk management class this. So anybody know who that is?
Oh, I was gonna ask, for the exam, what kind of option strategies would be like?
We're going to show you. It's those 4 that we've just done. So protected put, covered call, collar, and straddle.
Okay.
There's only 4 you have to do. All right. So this is Joe Robles. And this is his letter on the annual report. And he wrote about my portfolios. So this is kind of cool. My last year, I'm about to retire. He said, in fact, USA's PNC equity portfolio returned 1%. So why did I get written up for making 1%? That seems pretty pathetic, doesn't it? Why did I get so much press for making 1%? because the market was down 37%. How did we do that? With options. Now the collar was our strategy, but we decided in the November, and I can probably show this to you. We decided in November to take all the options off and just go in the S&P 500. See if I can bring this in. And we had a big debate about this. My boss was freaking out about it. So we went and met with Joe Robles. I'm a huge fan of Joe Robles. Great CEO, great man, just period, but great CEO. I don't know why they make you do things twice here, but. So my boss is freaking out. We can't do because 2008 is already a pretty bad year at that point. The previous CEO had us 0% in stocks. He hated stocks. I'm the stock guy. Joe comes in his first year, and I get us back into stocks right before the financial crisis. So I'm pretty stupid. And he's the CEO. So I go to Joe. We're down about 9%. And I go to Joe and said, I want to take all the options off. I just want to ride the market. One of my peers were saying, yeah, but the market's really volatile right now. If you sell those call options, you can get a really big premium. And said, yeah, but they're expensive because everybody's worried about the market shooting back up. So I don't know if I can find it or not. I hate doing this because it never works. Let's see if we can get. I can't remember exactly when in November we did this. I can show you the trade I was talking about earlier. Probably went further in 2009 than I needed to. All right, so somewhere in here, we said, take the options off. And it rallied. You might not think that's a big rally. Start at what, 600? So we took the off somewhere. It may have been on that day because I remember it was just crazy. So 750 to where's 7, 9, 12, 31. So somewhere in here, the 869, 750 to 869. That's a pretty good market rally. It's like 15%. Pretty good rally. So we probably didn't do right there because I was down 9% when we met, and we're up 1% when the year ended. And if you look, what did the market do on the very last day of the year? Guess where I was on December 30th? I was negative. So I had a 1% return and the market was up 1.4% on the last day of the year. So you can see my boss was like, you better have a positive return. It's like, are you kidding me? The market's down like 40%. Why would you want a positive return? But I gave him a positive return all on December 31st. If the year had ended one day earlier, we would have had a negative return, but we had a positive return. All right. And then, where's my graph? It went away. Thanks, Bill Gates. Good job. Don't know where my graph is. I thought it was in here somewhere. There it is. And then we got back in January. So we started doing the strategy again. So guess where I bought that call back? You can see I was like, okay, let's buy those calls back because we can get them cheap. So that's why Credit Suisse was like, wow, you know what you're doing. I was like, no, this is pure luck. We just happen to meet on these days. Do you think we're stressed doing that? Pretty scary stuff. So yeah, especially a new CEO I really like, and I got them in stocks at a time. We've been out of stocks for some time. So these are powerful strategies. They do work quite well if you're patient and careful, huh?
So like option traders, what do they mean specializing in for education? Specializing in that?
Well, I don't know. It depends on what your strategy is. I don't know. Option traders. I wish we could talk to Eric. Eric is one in Chicago. Um, I don't know if you specialize. Just options are options. So you just get used to the pricing. You kind of the guy Stewart that I used at Credit Suisse, things like delta and gamma, his mind could see it magically without doing any calculations. He just understood everything. I couldn't do that. I had to sit down and think through gamma real carefully. Where are we in the curve? What happens here? He could off the top of his head could do those kind of things. I don't know if he had these. It's like he had the formula not necessarily memorized, but he knew exactly how everything hit the formula, how material it was. But you know, you learn options just by doing them every single day. It's its own unique market. You start learning things pretty well. He was the greatest person to talk to. He was so smart. Um, but yeah, I mean, if you're going to do options, do it with the paper portfolio start. I've been mentoring this high school kid. He's doing his big presentation. He built it was pretty cool. He did a pitch book. He created his own investment firm. He's up like 300%. Well, he was doing some pretty aggressive option trades. And I was like, yeah, you're pretty lucky that you're up that much. He was pretty lucky. Um, so is he a great investor? I don't know, but he was at least lucky. But when you have that kind of success with options, it's almost bad to start with success. It's almost better to start with failure so you can learn. That's how you learn options is making some really bad trades. I've made some really horrible trades. But fortunately for me, I did my horrible trades on my own personal money, not with USA's money. So I learned on my money, not on their money. All right. So here's the strategies you need for the exam. Protected put, covered call, straddle, collar, straddle, and strangle. So remember, straddle is if, and I could have done a straddle, if, you know, we could do a straddle. I essentially did do a straddle for Tesla because a straddle, the strike was right at 190. So if the stock's trading for 190 and your strike's for 190, that's a straddle. A strangle is going to be a little out of the money. So if they're trading for 190.16 or something, you're not going to be able to do it exactly at that. So I'll probably give you a strangle on the exam and then a collar. So if you had to, so let's start off with what are these things? Just a quick review, and then we'll practice more. You'll have the team question. So a long call, what's the gain there? Long call. Give me the full formula. Max, don't forget Max.
Like price, strike, zero, minus the.
What's the intrinsic value? That's the intrinsic value. And then the option value is the intrinsic value. Why are we using intrinsic value? Because we're doing everything at expiration. At expiration, intrinsic value is the same as the option value. Before that, what else do you add to the option premium? Equals intrinsic value plus what? Plus time value. At expiration, what is time value? 0. All right. So we're doing everything at expiration. So this is the formula for intrinsic value. This doesn't work 3 weeks before it matures because you also have time values. We're ignoring time value. All right. That's what keeps it really simple. All right. What about a long put? Now y'all getting tired of knowing and saying this, but keep practicing. Not really difficult formulas, right? There's the intrinsic value, At expiration, you subtract what you initially paid for it, and that's going to be your gain or loss. Before then, you have to add some time value. You have to add some time value. All right. And then we do a protective put. Just tell me what's there. So long the stock and long or short to put. Long to put. All right. So the stock is just what it's worth today minus what you paid it. That's pretty simple. And the put, how do you get the put? Well, there it is right there. So nothing new there. Covered call. What are your pieces there? Do you own the stock? Long the stock. Short the call. All right. So here you're going to use the ask. Here you're going to use the bid. But you don't have to memorize that. If you're buying something, use the higher price. If you're selling something, use the lower price. That's pretty simple. Okay, caller, what do you have here? Do you own the stock? Remember, the caller is you just combine these two things. So that makes it pretty simple. Long the stock, long the put, short the call. Right, just have those three pieces in there. You own the stock here. So here you just long a put, long a call. Now there are people who do short stringers and straddles where you sell. It's pretty cool because you get a lot of money. But boy, if that stock price moves, you can lose a lot of money, right? You're unlimited loss. So it's a pretty dangerous strategy. So my favorite, we saw those iron condors. So if I were short a strangle, I would probably buy the calls and puts further out that protect me on the downside. But these are the ones you need to know for the exam. We'll do some practice. What I will do is probably on Thursday at 4. We'll see, but we'll see. I'll let y'all know. But I'll do like special office hours where I'll work a previous exam. And if you want to sit in, you can, but then I'll put it on Zoom. We already have one out there, right? You've had it for the practice already, but we'll do another one so you can practice. This is not an overly difficult question. Make sure you at least get these first two right. The only other thing I ask you is time value. So time value just equals the option premium minus the intrinsic value. And we've already seen the intrinsic value. For a call, that's the intrinsic value. For a put, that's it. So time value is a really simple question. Here's the option premium. Subtract that intrinsic value, you've got the time value. All right, so that's the entire question. We'll do a practice on Wednesday to get ready. Get some practice for the final. So let's talk through this. So you're going to be using that max S minus X comma 0. That's the intrinsic value minus the premium. Or you'll be using the X minus S. Those are really the only two formulas you need. The time value is the premium minus the intrinsic value, which is what these are. Which of these is a call and which one's a put? Yeah, that's a call, a put, and then that's time value, whether it's a put or a call, right? So that's all the formulas you need. So this is really, really simple, other than you have to get the stock value. So this first one's a call. So we're going to do the equal max of, you got a call strike price of 165. We need that second. At expiration, it's trading at 172. The strike is 165. That in 0. So there's the intrinsic value, $7. How much did we spend for it? 180. So did y'all get 520? That sound right? All right, on the put option, we're going to do the max. And here we're going to start with the strike. Put option, the strike of 160. If the Stock's trading at 139. How much do we pay for this one? 940. So there you made 1160. Does that sound right? I should look at y'all's answers to see. I guess I should look at team fives, right? We got 520. They got 1160, so that makes me confident. All right. Protective puts. So a protective put, what do you own? Long the stock, long the put. So the stock value at the strike 160, assume your stock's trading at 110. So the stock is 110, you bought it at 155. So that's a loss of 45. And then we just do the same thing again, equal max, strike a 160 minus 110, comma 0. How much do we pay for it? 940 again. So add those two together, we have a loss. 440. I did see a lot of 440s. Kind of confusing because it's also the answer to D, but we'll see. All right. So, yeah, see, this isn't really difficult math, right? It's because you're only using the same, you keep using the same formulas over and over and over again. So you just have to know the order. The last one, the time value on the put option. This is as a time that you bought it, all right? So you start off, again, the same formula. So the strike was in B, the strike was 160. The current price is 155. So we're doing it as of expiration. So it's in the money, right? $5 in the money. So there's the intrinsic value. Premium is what? Premium is 940. So the time value, 940 minus 5. So 440 again. I didn't actually plan it that way. Don't expect that on the exam. So 440 again. What if you got negative 440? You know you did it wrong because time value can never be negative. It's always positive. So it's impossible. I don't think in the history of options we've ever had a negative time value unless there's some bizarre bid ask that was just, you would have discovered at the trade that you had the wrong price. All right.
So when you're buying a put.
Well, that's what I was asking here, the time value on the put. Since I said in B, you're long on the put. So yeah, you assume you use the ask price. All right. Everybody see that? All right. Any questions on that? We'll do some more practice on options here. All right, papers 2 and 3, just a few comments, just talking to a lot of students in the last few days. All right, so the tutorial video, you have two. You have the one I created some time ago, and you had the one I did in class. The one in class is a little easier. If you use any old one, just a few comments to make. First, we're not doing, no, that's interesting. I hit the caps on the word capitalize. I hate the cap lock, capitalize earnings. So you're not doing that. If you put that in your paper, I'll just ignore it. So we're not doing capitalized earnings. There's no S&P 500 index file to load because, and I showed y'all this in class, if you go to Yahoo Finance, where you can see the market reacting to the Fed's announcement. Initial reaction, and then the end of the day. So it's like, wow, this is great and not so great. So what happened here? Who knows? Was Powell talking during this time and he said something? Who knows? So I don't think he said anything radically new today. It didn't sound like it. But anyways, so if you click on this, yeah, it's true. On this one right here, this is the GSPC, and you click on history. Yeah, there's no download button. But I showed you in class, you can use the SPX, and that one does have the download button. So you don't need me to give you the file. You can create your own file, all right? It works just as well. So you've got everything you need. And I'd rather you do that because you need to know that that's available. So why they make this distinction between these two indices, I don't know, but you have everything you need there. Um, um, so dividend versus free cash flow. So I've gotten questions on that. So dividend discount models use dividends. Why did you do that? Dividend models assume dividends equal what? That they equal free cash flow. So which would be more theoretically logical to use, dividends or free cash flow? If you're trying to find a proxy for free cash flow, what's a better proxy for free cash flow, dividends or free cash flow? Free cash flow. So you can use free cash flow. It's pretty simple to do. Yahoo, or my formula is overly simplified. So when you take Cat Beckham's class, he'll go much more in free cash flow. It's a pretty important concept. I'm a believer that it's not an easy number to calculate. That every firm, it's going to be different. You're going to have to do quite a bit of extra analysis. I have a whole blog on that. It's not as easy as the textbooks make it, but in Yahoo Finance, you just go to financials, cash flow statement, and you take cash from operations minus cap X. Cap X is actually called your CFO is just that top line. I'll call it what it is here. Operating cash flow. And cap X is actually under investing cash flows, cash from continuing. It's the net PP&E. I don't include business purchases, this line, because that's obviously a free cash flow. If you're buying other businesses, you must be producing free cash flow. You can't say you're buying another business to maintain your current capacity. The investment you definitely don't want to include, because what the investment is these are firms that produce a lot of extra free cash flow and they're buying bonds that park the cash. So that's obviously a free cash flow. So we're saying this line right here is really not free cash flow. They have to reinvest in the firm just to maintain things. So that's the line we take out. Pretty straightforward. So that divided by shares out. So there you go to the income statement. I mean, it's amazing. You only need 3 numbers. Income statement. And I usually use diluted average shares. It's not a bad one to use. Maybe do several years to normalize. That may make some sense. If this last year is incredibly unusual, you might go back a few more years and just see, hey, maybe there's something else going on. You don't have to do this. You can use dividends. It depends on the firm. I mean, I showed y'all Walmart in class, and it looked like free cash flow gave us a much better answer. But what do we mean by much better answer? So the last thing, your valuation can be radically different than current stock price. What do students want to do? Oh, I got 84 bucks and it's trading for 162. I must have done something wrong. That's the wrong attitude. Just go with what you get. All right. I got 20 bucks and it's trading for 87. I must have done something wrong. I better use a higher growth rate. That's not the right. I was showing Omar. How many companies did I show you? 5 or 6, right? Here's a stock that was trading for 100 bucks. Now it's trading for 500. Here's a stock that was trading for 400. Now it's trading for 80. And that was like less than a year ago, right? I showed him within a year, we have stocks that are 5-fold different. So if you're off 3-fold, 4-fold, go with it. That could be the right answer. If you're worried about LinkedIn, I would go. I mean, they love boldness. So, yeah, I think this stock's worth 100 bucks. It's trading for 20. I'm gonna go. I'm gonna say buy this stock. Go back and check that you don't have an obvious math error. That'd be pretty good to do, right? If your discount rate is you think 8%, but you're actually using 80% because you have a decimal off, then yeah, that's going to be a problem. But yeah, so double check your numbers. Make sure your 5% growth rate, you didn't accidentally hit 50% or 0.5%. So just be real careful. But there's no reason stocks have been moving dramatically. We had 23 stocks last week up 10%, right? Camille, we did that in our paper.
Yes, sir.
23 stocks, and Carlos, that's a lot of stocks, up 10% in 1 week. So stocks can move a bunch because valuation, why are valuations so difficult? You're taking the present value of infinity. For a stock like Alphabet, you need to be accurate out about 150 years to get a good stock price. How many of y'all know what Alphabet's going to look like in 150 years? Do you have any? Will they even be in business in 150 years? They may be completely replaced by AI. Who knows? We may not have any companies. We may be all like Star Trek, and there's just, computers do everything. We just sit around eating and kind of order stuff by pushing a button. There's no workers. Who knows what this is going to be? So, your valuation can be radically off, mainly because that's the nature of valuation. They're really, really radically off. We used to do the stock the sector wars and investment society. We're trying to bring that back up, but I hired some CFAs from in town to judge, and they did the data tables with really wide valuations. And one of those judges says, oh, those valuations just way too different. And I kind of humored him and said, okay, but I believe they really are that radically different. Valuing a stock is extremely difficult to do. So if a year ago you had Nvidia at 500 bucks, and people said, you're crazy. It's only trading for 100. How can you beat that far off? Don't you wish you had bet the farm on that stock? Would have worked out really well. So have confidence. If you take your first job and your goal is to come up with a valuation really close to the current price, well, how much does your boss pay you to do that? Hey, boss, I'm going to change my assumptions so I get the current price, and I'll give you my analysis a little bit later. Your boss says, well, I can look up the current price. I don't really need you to do that for me. So be bold, put down what you believe. Don't even look at the current price. Be bold, put down what you believe. If it's really different, then what do you say? What's the first question? My value, 350, current price, 80. What's the first question? What's the first question most students actually ask? What's the rest of that question? What did I do wrong? What's the correct first question?
What might explain this?
Okay, I'll explain. The way I ask it is, how do I differ from the market? Where's my disagreement? Is it the growth rate? Is it the free cash flow? Is it the discount rate? Now you don't know that, right? Because you don't know what the market's assuming, but that's what you're wondering. The best analysts, this is what they tell their boss. So if you want a great paper, you say, hey, what? And your answer, so David, the answer is going to be where I think the market has it wrong is. That's the best answer. Why? Because it sets up the catalyst. Hey, they're really missing out on these margins. Well, that's pretty obvious. In the next couple of quarters, you're going to figure out if you're right or not. Are they really missing out on the revenue growth in China? You're going to know that. Now, if you say they're going to missing out on revenue growth in China over the next 50 years, then yeah, it's going to take a while to figure it out. But most of these, where I think the market has it wrong, you'll figure this out in the next 3 to 6 months. And then your boss is saying, okay, I see that. And oh, by the way, yeah, we're going to know if you're right or not. That's what bosses, that's what you get paid the big bucks. What's the downside of this? Is your boss is going to know when you're wrong. But if you're really good at what you're doing, you put this down, you're going to make a fortune as an analyst. This is what bosses are looking for. If you want to do great in an interview, that's what you want to say. Hey, I was valuing this stock. I got a really high value. I think the market's really missing on this point. They may strongly disagree with you, but if you say that, you don't, you're off the charts as an interviewee. All right. What else is going on papers 3 and 4 that are bothering y'all? What about your firm's dividend yield? How are y'all using that? Not your dividend, but your firm's dividend yield. Where are you using that in the paper? Kind of a trick question. Never used. If you're using your firm's dividend yield, then you've made a mistake. All right. Huh? Yeah, I use the S&P 500's dividend yield, but you never use your company's. What about your company's risk-free rate? Does that make sense? Your paper, the risk-free rate I'm using for Apple is 4.3. You would never say it, right? Because that's also the same risk-free rate you're going to use for 500 other companies. All right. What about your company's market risk premium? Doesn't make any sense. You would never say that. The market risk premium used for NVIDIA is this. No, you can say the market risk premium I use is this. When do you talk about NVIDIA? When's the first time you talk about your firms? Beta, yeah. Beta is the first time. So paper 3, your first 2 things have nothing to do with your company. If I see a phrase like, for my company, I'm using this, it just sounds strange, all right? So you don't even talk about, you're saying the risk-free rate, not for my company, the risk-free rate we use is X. The market risk premium uses X, and you ignore your company. So where do people mess up on the market risk premium? They talk about their company's expected growth. That doesn't even come up in paper 3. That comes up in paper 4. Paper 3, you don't talk anything about your company's growth. You're talking about the growth of the S&P 500. All right. So that has nothing to do with your paper. What if you get a KE is 6% and long-term growth is 7.2%? What are you going to do there? What happens when you do that? Get a negative number. So yes, students have submitted papers with a negative valuation and said their stock was overpriced. That just boggles my mind. I think people are just typing away. I did everything I was supposed to do and type it. It's like, wait, maybe I should step back and look and see if this makes sense, right? You always want to do that. It's always a learning experience. So don't get so much in the weeds that you don't just see the obvious. There are no stocks that are worth negative values. There may be some worth 0, but there aren't any that are worth negative value. So if you get a negative value, what do you have to do? You either got to increase that or reduce that. That's your only choice, right? What if your long-term growth rate is 5.9%? So if this previous one, what's the true value of the firm? The true value is infinity, right? It's not negative, it's just the formula. But what if your long-term growth rate is 5.9? What are you doing? You're approaching infinity. So you can get a massive, massive number. That's, you say, well, Walmart's trading for $150. My valuation is $87 million. You might think you have an error. That's the point where this doesn't apply. If you're getting $80,000 versus 100, yeah, you probably have a growth rate that's too close to your discount rate, and that's going to be an issue. So be careful of those kind of things.
Why is a negative value possible?
Well, if you buy a stock for $100, what's the lowest that stock can be?
Oh, okay.
Zero, right? Are they going to come to you and say, hey, you owe us $100? Now, in Lloyd's of London, that is possible.
Really?
Yeah, you have unlimited liabilities. So if you invest Lloyd's of London and that firm messes up, they'll call you and say, hey, they're out of money. You got to send them more money. How many of y'all would invest that way? Pretty dangerous, right? So remember, we have limited liability in the United States. So the most you can lose is what you invested.
So even if would you note that if we could lose more than all of our money, we would lose more than all of our money?
Well, that's not what this is saying though, right? It's just the opposite. If the growth rate's greater than 6, it's not that it's worth negative, it's worth infinity. It's just that the formula doesn't know how to handle infinity.
Oh.
All right. As these two get closer together, the value goes up and goes up and goes up, and they get really close, it goes massive. And then when it crosses over, the formula says, I don't know how to handle that, so it gives you a negative number.
Oh.
But it's actually worth infinity. All right. There aren't any stocks worth infinity either. All right. There aren't any negative ones. If I have stocks and say, hey, I'm selling this stock, I'll give you $100 if you'll take it from me. I take the $100 in the stock. If someone says, hey, this stock's worth infinity, I'll give you infinity times 90%. Would you buy from them? No, there's no stocks worth infinity. There's no stocks that are negative. And as your growth rate approaches your KE, you are approaching infinity. All right. And so that's pretty critical as well, that you just understand you can get some radically strange numbers just because those numbers are really close. So remember what I said in paper 3. If KE is risk-free plus beta times the market risk premium, and the market risk premium is expected return minus risk-free rate. The expected return is dividend yield, this earnings growth. One way you can help yourself is to add in the stock buyback. Why does that help you? It gives you a higher discount rate, and that allows you to have a higher growth rate. That's one of the reasons I encourage you, add that 1.5% stock buyback. It helps give you a higher discount rate, and then you don't have that issue of approaching infinity. And I do think stock buybacks is pretty important to the valuation. All right. Anything else on papers 3 and 4? Pretty powerful paper. Probably of the papers, it's probably the best one to put on LinkedIn. All right. So let's do one last thing on options. All right, so let's start off one last time with the formulas. You write them down. So you need 1, 2, 3, maybe 4 formulas. Let's write those. Well, maybe, yeah, it may be more than 4. We'll see. So just write down the ones you remember. So I'm gonna be bold and do the first one because that's the easiest, right? Okay, you have more to choose from. Who's got one? Sebastian?
This is for the option, right?
Yeah.
It says the S, so it's max. And then S minus X. 0.
All right, so what? All right. So if you minus the premium. So what specifically is minus the premium? When you add minus the premium, what are you getting?
What?
What is minus the premium changing? Well, before we do minus the premium, Sebastian, what is this formula by itself?
I think the answer is.
So this is the intrinsic value of what? Of a call option, all right? Intrinsic value of a call option, all right? Now, when you do that and then you subtract the premium, it's the expiration of what? Well, that's the expiration value of the option. Yeah, it's the gain or loss at expiration. It's not the gain or loss before expiration because we also have time value, right? Time value is not in there on that gain. So you'd have time value at here and then your original premium that you paid, all right? So you'll need these two formulas. Just realize it's the same formula. So the gain or loss is intrinsic value minus what you paid for the option. The intrinsic value is intrinsic value. So you need to know intrinsic value. All right, somebody else. What else do we have? Give me the whole thing. The blank blah blah is blank. Anybody got it?
Put option. Right. Gain or loss, which is the same thing. Just
Yeah, so it's the same thing again. So we could simplify the gain or loss to one formula. The gain or loss is what? Intrinsic value minus the premium, right? So it's the same calls and puts. It's your expiration is that intrinsic value, which might be zero if it's out of the money, intrinsic value minus the premium. So that's true for both of those. If you're long, what option premium do you use? Ask are larger. That's easy to remember. If you're short, use the bid, lower number. So that's pretty much it. We know the gain loss on long stock is very, very easy. It's just ending value minus beginning value. That's pretty straightforward. So that one's obvious if you long the stock. So all you have to know is which of these strategies you have. All right. So not a lot, really not that many formulas. And these aren't formulas down here. These are just telling you which option to use. So it's really 4 really simple formulas. So it shouldn't be a difficult question at all. All right, and then the strategies. Y'all remember which strategies I'm going to give you? The covered call, protected put, collar, and what was the last one? Strangle. All right, one person give me covered call. What do you own?
Change in stock price.
Well, not the formula, just what do you own?
You own
The stock. And what? No, not long the call. Short the call. Yeah. If you're long the call, boy, that'd be really aggressive, right? Because you're really hoping that stock price goes up. You'd be somewhat leveraging. But yeah, you got the call right. So here you're going to use what? Bid or ask? Use the bid there. All right. Protected put. Long the stock and long the put. So you'll use the ask. Collar.
Protected put and cover call.
Yeah. So long the stock, long put, and short the call. And then strangle, pretty straightforward.
On the put.
1 foot. All right, so those are the only 4 I'm giving you. I can't really give you spreads because they're pretty tough to do. I just have to give you too much data, but spreads, they can be counter spreads or spreads within the puts. So that's all the possibilities. This is a pretty good list of making sure on the basics you know them, and then you can get into that and look in some others. Most of the other fancy strategies are spreads. The condors are all those butterfly kind of things. Most of them are spreads where you're trying to take some position, but you don't want unlimited loss, which I agree with. I don't like unlimited loss. And so you somewhat protect it by buying something further out of the money or something. And they're really interesting strategies. They're more interesting at sometimes versus others. So they're kind of strategies you have to watch over time. But that's the entire question there. So, all right. So it's where I give you that. So on Canvas, we have the exam guide, and then you have a practice exam. So what I'm thinking is, and I'll email this out, is so tomorrow's a dead day. We can't have class, but I can have office hours. So there's no class tomorrow. However, tomorrow, I will have a Zoom office hours. So if you want to attend my office hours tomorrow at 4 o'clock, I will work practice exam. Okay. So I can't have office hours, but I can't have a class, but if 40 people come to office hours, I can't do anything about that. It's my office hours. All right. So don't tell anybody I had a study class or study review class. I don't. I'm just doing Zoom tomorrow. I will film it. I will put it out there on our links so you have it. You already had one from a previous class, so you've been seeing that for the team practice. Some of the questions on this practice exam you probably have seen before because as team questions. So yeah, it's out there. It says Hormel all the way down except for the very end. Oh, it is Hormel at the very end. So yeah, it's Hormel all the way down. So you've been seeing a lot of Hormel. Today you would have seen Hormel, except Hormel was already out there. So I picked another company for the option today. So you wouldn't already have the question. So I had to do something. So you've got all of those. We'll work through these tomorrow and I'll film it. And then you should be ready for the exam on Monday, right? So, huh? I can't remember. Yeah, I think it's at 3. Yeah. All right. It's in here. It's closed book, calculators. So, all right. Any questions on what I mean by for tomorrow? All right. So, and if you want to ask questions and all that, you can watch and ask questions. Some of you are saying you want to work it in advance. That wouldn't be a bad thing to do at all. All right. So many people are leaving. I feel bad keeping y'all here, but I don't want to leave yet. So I'll leave you with one last thing. We will leave early since everybody's just leaving, but so Poor Munger passed away, I think this year, just recently at a pretty ripe old age. There's a lot of YouTubes of him. So he says he's not, one of the smartest ones. I'm not sure Warren Buffett and he are necessarily the kings of quant and all that, but seem to be smart people or just lucky. But he says, I constantly see people rise in life who are not the smartest, some not even diligent, but they are learning machines. They go to bed every night a little wiser than they got up. And boy, does that help, particularly when you have a long road run ahead of you. I think that a life properly lived is just learn, learn, learn. I see that with students, boy, it frustrates me. Students don't come to class, or they don't take notes, or they look bored, or they're on their phone. Seeing students on their phone, you can't imagine anything more demoralizing to a professor. So if I were you, I would be desperate in every class to learn every single thing I could learn, and I would be going out and Googling stuff. You're in a unique world where the world's going to be radically different for you than it was for me because of AI and everything else. I will be desperately learning everything I could possibly learn, teaching myself every chance I get. When you get out there, just learning, learning, learning. Every class you take, you get a horrible professor, you should drop the class and take someone else. And every chance you have. So it is learn, learn, learn. So I like the way Annie Doo talks about it. It's compounding. You all know how compounding interest works, right? You start investing in your 20s, it doesn't make much difference a year later, 2 years later, but 30 years later, it's the same thing, the compounding of learning. You make sure every day you've got more knowledge. And then over 10 years, so at USA, people got mad at me because why is he getting promoted? It's like, because I'm here an extra 2 hours. I'm talking to the actuaries. I'm talking to the PhD in math. I'm doing all this stuff. I'm going to committee meetings. I'm volunteering for work, doing projects. 10 years later, they're like, hey, it's not fair he got promoted. Yeah, it is fair. I put the time in, I learned new stuff. So this is the key. Some students think, well, college doesn't teach you important stuff. I'll get a job and learn it then. You're going to really waste 4 years of your life. So now's the time, and I be desperately learning. So I wish you the best. Any of y'all graduating this semester? A few of y'all, so wish you well. Hope y'all all do well, but be a Charlie Munger. I won't do my Ivan Ivalich. You can ask Miranda about that one. It's too depressing, right? So, all right. I'll see y'all at the final.